Today's topic is AI, automation, robot-related ETFs. So before we go to the ETF list, so this one I made a video, I think a few weeks ago. So when you talk about fourth industrial revolution, it was from IoT to things with the smartphones. So before, like your refrigerator, TV, or your car has some sensor or related connected with internet. But now it's thinking like you talk to your refrigerator, and then your refrigerator connects you with your TV or your thermostat possible. And then, or if you ask your refrigerator, and then it can help you talk with your friend possible, because now those things have smartphones. So not only internet connected, that also they give you some service, and you can have communication with the things, and then you can have communication with your friend or things through the your device. So that means things with the smartphones. So of course it your future, but not today. But when you think about future, which means we invest for future, right? So in the fourth industrial revolution, the main three field. In the cloud field, when you think about cloud, you can have, like, I can, what you say, the Amazon, Microsoft, Google in US area or in Europe. And then when think about in China, the cloud system, it may be the Alibaba and Tencent. So it means those five companies cover most of the global market. And recently, the President Trump made the order to ban TikTok or and also TikTok and WeChat, though, and for the regional, the national security, because those Chinese app still is stealing the Americans' personal data. So that's the security issue in digital data area. So before the G2 problem was in the trading, now in the moving to the digital data field. So later on, I think the issue move to the artificial intelligence. Anyway, today I'm talking about the ETF in this field. So when I say AI ETFs, then basically it includes AI, automation, and robotics. In this AI market in 2019, the market size is 39.9 billion, and then it is expected growing between 22 to 2027, annually 42.2%. So when you invest this field, you can expect in generally of around 40% every year for 7 years. That's very generous return. In fidelity.com, without the login, you can see this information. So the first one is a Robo. The ticker is ROBO. The Robo Global Robotics and Automation Index ETF. So when you see the chart here for 1 year, so it go up more than the last time in February price, and then I think it's going up further. And then when you see this one, net asset is 1.3 billion, and then net expense ratio is 0.95%, which means that when you invest $10,000, and you need to pay $95 annually for expense. Okay, and then the inception date is October 2013. So when you see the okay, we go to the going down here. So performance, when you see it incepted to 2013, but we didn't much have returns. But in the middle of 2015, it go up a lot, and then so in 2016 it actually go up more, and then up to the 2017. But after that, it going side and down more, and recently go up again. So people talk about the AIs a lot more than 10-20 years ago, but actually as the investors, we got benefit from 2016. Okay. We go down. See here this ETF has 47 individual stocks, and then top 10 is 17.6%, and most of them is the medium market cap companies. So we go more details. See, those are top 10 among 87, and then the top 10 is 17.6%. So when going down, the IT sector is 48%, industrial is 36%. But when you see the more detailed sectors, which means the industrial exposure, mainly machinery, electro equipment, so those are the more than 50%. So they're more focused on, looks like on automation and robots. So go up, and the regional exposure to the North America 47%, Asia 29%, Europe 22%, and then country exposure, US 46%, Japan 18%, Germany 7%. And then the large cap 41%, mid cap is 24%, small 19%. So the currency exposure, US dollar 46%, Japanese yen 18.8%, euro 12%. Second thing is the ticker BOTZ, BOTZ, Globalx, Robotics, and Artificial Intelligence ETF. So when you see the chart, it go up more than the last February price, and this one is net asset is 1.7 billion, and net expenditure ratio is 0.68%, and inception date is September 2016, so 3 years later than the previous one, the Robo, right? And so when you see as I told you, from the 2016 2017, those kind of ETF go up and then go down and then go to side, and recently go up again. So I think this is a good time to start investing AI ETF. So it's going down, and then it has totally 32 stocks, and then top 10 is over here, and then they are mostly like large cap growth stocks. So we go to the detail here. So the top 10 is 63%, so it's very concentrated on the top 10. And sector exposure is industry and information is among the over 70%, and the industry exposure is more machinery and electric equipment, and those equipment again. So those parts semiconductor, those parts, so which means they are more focused on automation and robotics. So as you go up, Asia is 42%, North America is 37%, Europe is 20%. The country exposure, Japan 42%, US 35%. So Japan is the main country in this ETF. And then this one, as I told you, so the currency exposure more Japanese yen. third one is ROBT, and then first trust Nasdaq Artificial Intel and Robotic ETF. So the chart is like a previous one, but this one is the net asset is smaller than the previous two ETFs. So it's the 160 million, and then net expenditure ratio is 0.65%, and the inception date is the February 2018. So it's the kind of recent incepted ETF. So as I told you, from 2016 it go to side, and then recently go up again, right? So it's showing the same trend. So it's going down, and then we go see the more details about portfolio. So here they have 102 stocks, and then the top 10 is 21%, which means through the 102 stocks, they almost equally distributed. And then industrial sector exposure is the IT and industry, and the industrial exposure is the software is 31%. So compared to the previous two ETF, this one is more focused on software instead of the equipment. So regional exposure is in North America 54%, Europe is 21%, Asia 20%, and so country exposure, US 52%. So it's mainly US, and Japan is 14%, and most of them is the large cap is the percentage higher, but overall the mid cap growth stocks, medium cap growth stocks, and then the currency exposure is US 52%, Japanese yen 14%, Euro is the 10%. Fourth one is the iRobo. So the iShare Robotics and Artificial Intel multi-sector ETF. So the chart looks like the previous ones, and then the net asset is 167 million, and then net expenditure ratio is the lowest among them, 0.47%. Inception date is the June 2018. So we're going down. So this one, as I told you, right, 17 go up, and then go to side up to the recent time, and then go up again, right? So this is a good time to start the AI ETF. So here, let's go more detail about portfolio. Here the 102 stocks here, top 10 is 13%, which means like the previous one, they equally equally weighed 102 stocks, and going down. So the sector exposure mainly IT sector and communication. Next one is more as you see, software focused one. And North America 54%, Asia 32%, country exposure US 53%, China 16%. So we see the China here first time, and Japan is 8%. So this one is more related to Chinese stocks. So overall, they have a large cap market cap growth stocks. And then currency exposure, US dollar 53%, Chinese yuan, that's 16%, Japanese yen 8%. So it's more related to Asian currency. The last one is a THNQ, like a ThinkQ. So the Global Artificial Intelligence ETF, and then this one is a net asset of 5.5 million, so it's a very small amount asset, and then next expenditure ratio is 0.68%, and inception date is this year, May. So that's why the chart is going up only, right? So baby ETF. So when you go to the more the portfolio details, they have 71 stocks, and then top 10 is 18%. So which means that they well equally distributed to the 71 stocks. And here sector exposure, mainly IT, the 66%, and then consumer discretionary is 13%. I think the consumer discretionary means I think a Tesla here. Okay, and then so here software 36%, IT service 14%. So this one is a more software focused ETF. And here the regional exposure, North America 74%, Europe 14%, and country exposure, US 74%, China 6%, France 3%. And here the many composed of large market cap growth stocks. And then the currency exposure, US dollar 74%. So when we see the 5 ETF now, but it's like I don't much remember, you don't much remember, right? Because we just look through. Like when you go to shopping for your shoes or t-shirts, before you buy, just look through the market one time. After that, you making some the standard, so and then you go back and then check the quality and price and you buy, right? So so now, okay, summarizing what we saw today. So in artificial intelligence sector, there are three main things like robotics, automation, and artificial intelligence. So in Japan, they more strong as the robotics and automation, or German maybe automation things, and then artificial intelligence is now recently more developing, and then people put the money more there. And so the three sectors. So which field are you thinking is a more good future or this time? So it's when you think about those investments, you should think about this time is which one first, and then the 3 or 2 years later, which is which field they're gonna develop more, kind of way. So when you see the ETF, it starts from incepted 2013. So they more focus on automation and robotics. And then when you see now, 2018 and 2020, they more focus on software, which means the more AIs. So when you see the automatic and robotics, their industry is the kind of time to making profit. So it's when you buy them, those companies are making profit, so you can see the result sooner. But when you more invest for the artificial focused weight the field, then you maybe wait a little bit more longer. Okay, so the other one is now when you're shopping those ETF or some individual stocks in that ETFs, then I think number one is we need to see the sector exposure. So it's more focused on the the industrial focus, or it's more focused on the software. And then second thing is when you go to details, I mean sectors, that's industrial exposure. So it's as number one. So you need to see the the category first. Number three is the regional exposure. Recently, G2 have not good relationship. So it's as I told you, now they say the kind of trade war. They started trade war, but now it's more that the world moved to the digital data security. So depending on the regional exposure, you maybe have the more unstable or stable ETF. Number four is a country, so it's number three. Number four is related, right? And then another one, as I told you, when you more focus on like Japan, it's more like robotics, or German more like automation kind of way. So each country has there's some the developed part. So depending on the country, you may be thinking about those sectors more stronger. And then fifth is market capitalization. Some ETF they have mostly medium market cap size stocks, which means those small companies the more volatile, but they probably have more growth potentials, especially the Fed rate is near the 0%. That time the growth stocks have more benefit because their expenditure is lower when they borrow money from the bank, right? So when you think about that way, until 2020, the Fed increased their rate. The small company stocks is I think more potential to go up. And but if you want to have a more stable portfolio, then I want to choose an ETF with large market cap stocks. Love once more, thank you twice.